Welcome to This Explainer. Today, we're diving into the fascinating, invisible mechanics of our economy by following the journey of a single dollar, straight from your wallet all the way to the central bank. If you've ever looked at a crumpled bill in your pocket and wondered how it actually holds any value, or how the broader economy functions around it, you are in the perfect place. We're going to unpack the entire monetary system together. Here is our roadmap for today. We're going to cover what money really is, the Federal Reserve System, how banks literally create money, the 2008 financial crisis, the Fed's policy toolkit, and finally, what happens when the whole system breaks down.
All right, part one. What is money really? We're looking at the fundamental functions and types of money.
So to understand the broader economy, we really have to grasp what that paper in your pocket actually represents. It's so easy to just take money for granted, right? But it's actually this profoundly important social convention. In economics, money isn't just a measure of your overall wealth. I mean, you could be incredibly wealthy because you own a massive mansion, but you can't exactly buy a cup of coffee with a brick from your house. Money is a very specific set of assets that we regularly use to buy goods and services from each other. It's basically the accepted convention that lets us trade freely without having to awkwardly barter our skills and goods for everything we need.
For any asset to truly act as money in an economy, it absolutely must perform three essential jobs perfectly. First off, it's got to be a medium of exchange. When you hand $1 to a barista, they accept it, no questions asked, in exchange for that coffee. Second, it acts as a unit of account. Think about it. We don't measure the cost of a car in terms of how many cows it equals. We use dollars as our universal yardstick to post prices and record debts. And third, it's a store of value. If you stash a $100 bill in a drawer today, you fully expect it to still hold its purchasing power next week or even next month. It transfers your wealth from the present straight into the future.
This whole setup really brilliantly illustrates the evolution of societal trust. Historically, societies used what we call commodity money. This is money that has intrinsic value, meaning it would still have value even if it wasn't used as currency. Gold is the classic example here, or actually, even cigarettes in World War II prisoner of war camps. But today, the US economy, and honestly most of the world, uses fiat money. Fiat money has literally zero intrinsic value. A dollar bill is, at the end of the day, just paper and green ink. It only works as money because of government decree, and, well, our collective, unwavering belief in that decree. Moving on to part two, the Federal Reserve System, let's meet the regulators of our fiat money. Because fiat currency has no intrinsic value and relies entirely on trust, somebody has to be responsible for managing it. In the United States, that agency is the Federal Reserve, or as we usually call it, the Fed. It was created back in 1913 after a series of really disastrous bank failures, and it serves as the ultimate overseer of the nation's banking system. It's run by a board of governors who serve these long 14-year terms just to insulate them from short-term politics, and they have a massive responsibility. They are the ones regulating the exact quantity of money floating around in the economy, which is what we call the money supply. To really wrap your head around the Fed's immense power, just imagine them flying a giant helicopter, dropping freshly printed bills down into the economy. That represents them increasing the money supply. On the flip side, imagine them using a massive vacuum cleaner to literally suck dollars right out of people's wallets to decrease that supply. Now, obviously their actual methods are way more complex than helicopters and vacuums, but this mental model, it's the absolute best first step to understanding what monetary policy actually achieves. Section 3. How banks create money. We are diving into the hidden magic of fractional reserve banking. Now, the Fed doesn't control this massive monetary system all by itself. You might think that when you deposit money, it just sits there in a vault waiting for you. Actually, modern banking operates on what's called a fractional reserve system. When you deposit your cash, the bank is only required to keep a tiny fraction of it on hand as reserves. So what do they do with the rest of it? They loan it out to other people. And this exact process, taking a deposit, holding a fraction, and lending out the remainder, literally creates brand new money in the economy. Crazy, right? Let's look at how the math actually works here. Say you deposit $100. That $100 is a liability for the bank because they owe it back to you, but they only keep 10%, so $10, as physical reserves. They take the other $90 and issue it as a loan. Think about this. Before you walked into that bank, the money supply was just your $100. But now, you still have a $100 bank balance, and a borrower out there has $90 in cash. The money supply just instantly became $190. And the wild part is, it doesn't just stop at one bank.
That $90 gets spent and then deposited into a second bank, which keeps 10% and loans out $81. This cascading chain reaction of lending and redepositing across the entire economy is called the money multiplier. It's proof that modern banking generates money practically out of thin air, with every single dollar of reserves. It's an incredibly efficient system, but it relies on one massive assumption: absolute stability.
Which brings us to Section 4, the 2008 financial crisis. This is what happens when the math turns against the banks.
So, like we said, this entire multiplier effect needs stability to work. To understand how that stability totally fractured in 2008, we need to quickly define two terms: bank capital and leverage. Bank capital is a bank's baseline resources, the actual money put in by its owners. Leverage, on the other hand, is using borrowed money to supplement that capital for investing. Banks rely heavily on leverage. When times are good, leverage amplifies their profits like crazy, but it's a double-edged sword. If the loans they issue go bad, leverage amplifies their losses just as fiercely. A bank's core capital can literally be wiped out in an instant, rendering them completely insolvent. And that perfectly sets the stage for what went down in 2008. Housing prices fell sharply nationwide. Suddenly, homeowners found themselves underwater and started defaulting on their mortgage loans. Because banks were so highly leveraged, these bad mortgages triggered terrifying outsized losses that ate straight through their bank capital. It sparked a total chain reaction of distress that threatened to bring down the entire financial system. The Fed was basically forced to step in with unprecedented action, pumping billions of dollars in rescue loans into the system just to keep these institutions afloat.
Let's move to Section 5, the Fed's policy toolkit. How exactly does the central bank exert control? To manage colossal crises like 2008, and just to steer the everyday money supply under normal conditions, the Federal Reserve relies on a very specific set of policy tools. By adjusting these levers, they indirectly steer the entire fractional reserve banking system, kind of like turning a massive cargo ship. Their primary tool is open market operations, which means buying or selling U.S. government bonds. If the Fed buys bonds from the public, they create new dollars to pay for them, handing those dollars directly to people and expanding the money supply. They also adjust reserve requirements to dictate how much banks can actually lend. And interestingly enough, during the 2008 crisis, they introduced a brand new tool: paying interest on the reserves that banks hold at the Fed. By raising that interest rate, they incentivize banks to just sit on their cash instead of lending it out, which hits the brakes on that money multiplier we talked about.
Now, when you hear about the Fed in the news, you're almost always hearing about interest rates. It is super important to distinguish between two specific rates here. The discount rate is the interest rate banks pay to borrow money directly from the Fed. But the federal funds rate? That's the short-term rate that banks charge each other for overnight loans just to meet their daily reserve requirements. The tricky part is the Fed doesn't just pass a law mandating the federal funds rate. Instead, they set a target for it, and then they use their open market operations, buying and selling those bonds, until the market naturally hits that exact target. And finally, Section 6, when the system breaks, the ultimate vulnerability of human confidence. Despite all of these incredibly sophisticated controls, the discount windows, the bond purchasing, the targeted rates, the Fed still faces one major unpredictable variable: human psychology. You see, if people lose confidence in the banking system and all rush to withdraw their cash at the exact same time, you get a bank run. It's famously depicted in the classic movie It's a Wonderful Life. Remember, because of fractional reserve banking, the bank doesn't actually have everyone's money just sitting in a vault. Most of it is out in the real world as loans. So if everyone demands their deposits simultaneously, the bank fails. And worse, for the broader economy, this panic throws the money multiplier into reverse. As banks scramble to hoard reserves and completely stop lending, the money supply violently shrinks, all without the Federal Reserve lifting a single finger. This entire system really is a delicate balancing act of math, policy, and deeply ingrained human trust. So I want to leave you with this final provocative thought. If the Fed can act as a giant helicopter, injecting endless dollars to stabilize crises and keep the banks afloat, what does that endless injection eventually do to the actual purchasing power of the cash sitting in your pocket right now? I'll leave that question hanging for you to ponder. Thanks for joining this explainer, and keep exploring the hidden mechanics of our world.